Banks are financial institutions that facilitate the flow of money between savers and borrowers. They provide a range of financial services, including deposit taking, lending, and investing. In this video, we will explore the various functions of banks and how they work. There are several types of banks, each with different functions and services. The most common types of banks include commercial banks. These are banks that primarily offer services to businesses and individuals. They accept deposits and offer loans, credit, and other financial products. Investment banks. These banks specialize in providing financial advice to businesses and governments. They help clients raise capital by issuing securities, such as stocks and bonds, and provide merger and acquisition advisory services. Central banks. These banks are responsible for implementing monetary policy, which involves managing the money supply, interest rates, and inflation. They also regulate and supervise the banking system. Development banks. These banks provide financial assistance to developing countries to promote economic growth and development. Functions of banks. Banks perform several important functions, including depository function. Banks accept deposits from customers, which can be withdrawn on demand or after a specified period. Deposits are a critical source of funding for banks, as they use this money to make loans and invest in other financial assets. Lending function. Banks provide loans to customers, which can be used for various purposes, such as buying a home, starting a business, or investing in stocks and bonds. Banks earn interest on these loans, which is a significant source of revenue. Payment function. Banks facilitate the transfer of money between individuals and businesses. They provide services such as checks, debit cards, and online banking to make payments easier and more convenient. Investment function. Banks invest in various financial assets, such as stocks, bonds, and real estate, to generate income and grow their capital. Banks use their expertise in financial markets to identify profitable investment opportunities. Advisory function. Banks provide financial advice to customers on a wide range of topics, such as investing, retirement planning, and risk management. They help customers make informed decisions about their finances and achieve their financial goals. Regulation of banks. Banks are highly regulated to ensure their stability and safety. The regulatory framework for banks varies by country, but typically involves capital requirements. Banks are required to maintain a certain level of capital, such as equity and reserves, to absorb losses and protect depositors. Deposit insurance. Governments provide deposit insurance to protect depositors in case a bank fails. Deposit insurance is usually provided by a government agency, such as the Federal Deposit Insurance Corporation, FDIC, in the United States. Supervision and regulation. Banks are subject to supervision and regulation by government agencies, such as the Federal Reserve in the United States. These agencies oversee the operations of banks and ensure compliance with regulations. The business model of banks involves accepting deposits from customers and using these funds to provide loans and other financial services. Banks generate revenue from the interest charged on loans and from fees charged for various services. Banks also invest in financial assets to generate additional income and grow their capital. Deposit taking. One of the primary functions of banks is to accept deposits from customers. Deposits can be made in various forms, including checking accounts, savings accounts, certificates of deposit, CDs, and money market accounts. Deposits are a crucial source of funding for banks, as they use this money to make loans and invest in other financial assets. Lending. Banks provide loans to customers for various purposes, such as buying a home, starting a business, or investing in stocks and bonds. Banks earn interest on these loans, which is a significant source of revenue. The interest rate charged on loans is usually higher than the interest rate paid on deposits, allowing banks to earn a profit on the spread. Fees and commissions. Banks charge fees for various services, such as account maintenance, wire transfers, and ATM withdrawals. They also earn commissions on investment products, such as mutual funds and insurance policies. Fees and commissions are a significant source of revenue for banks, as they provide a steady stream of income that is not dependent on interest rates or market conditions. Investing. Banks invest in various financial assets, such as stocks, bonds, and real estate, to generate income and grow their capital. Banks use their expertise in financial markets to identify profitable investment opportunities. They also invest in other financial institutions, such as venture capital firms and private equity funds. Foreign exchange. Banks earn income from currency exchange transactions, where they buy and sell foreign currencies to facilitate international trade and investment. Banks also provide foreign exchange services to customers, such as currency conversion and hedging against currency risk. Advisory services. Banks provide financial advice to customers on a wide range of topics, such as investing, retirement planning, and risk management. They help customers make informed decisions about their finances and achieve their financial goals. Banks also provide corporate advisory services, such as mergers and acquisitions, capital raising, and restructuring. Risk management banks manage various risks associated with their operations, such as credit risk, market risk, and operational risk. They use various tools, such as credit scoring models and risk management software, to identify and mitigate these risks. Banks also have regulatory requirements to maintain a certain level of capital to absorb losses and protect depositors. Thanks for watching. Like, share and subscribe.